Hi, Lisa. Thank you for coming in today. I'm really excited about you wanting to learn more about your portfolio, and that's an area that I have a lot of expertise in. And let's just get right into some of the questions you have today regarding beta calculation, some of the risks that you should be aware of, what's happening with your bond positions, finally, some of the performance on the portfolio that we've done calculations on, and the trainer ratio. But first of all, let's talk about the beta. We've calculated a beta on your equity holdings along with the mutual fund of 1.08. And a beta is also it's an expression of how volatile the investment portfolio is compared to the overall market. And in this case, we usually equate the overall market to the S&P 500. And if I can give you an example, if the S&P 500 were to increase by 10%, your portfolio would go up by 10.8%. Likewise, if the S&P 500 were to go down 10%, you'd most likely go down 9.2%. So you have a little bit higher beta than the market, which is usually a measure of 1. So at 1.08, you tend to have a little bit more aggressive equity holdings that may or may not be what you're looking for. Second, let's talk a little bit about some of the investment risks. And there's two ways to define investment risk. And the first way is what we call systematic risk, and really that's known as market risk or risk that we can't diversify from. And one of the things that really concerns me the most about your portfolio is you have an asset allocation with 71% in equities. And one of the things, even though we can't diversify away, we can establish some asset allocations that kind of meet your risk tolerance. And out of those equities, 4 of them are in four stocks that you've owned for quite a long time, and a fund. The other area that you have a lot of cash. So you do have a portfolio that has an asset allocation that I wouldn't say really seems to be similar to what your moderate risk profile is. It's kind of more of a moderate or moderate aggressive. Some of the other types of systematic risk would be interest rate movements, reinvestment risks, and finally purchasing power risk or inflation. So these are all different types of risks that we need to think about when we're putting together the portfolio. The other area is unsystematic risk, and this is some of the things that we're looking at here is concentration risk. And here we've got 4 stocks in the portfolio. One is over 20% of the portfolio. So here we have a really high concentration risk, and I need to get a better feel of what you're thinking about in regards to, you've had these stocks for a long time. Are you married to them? Do you, is there a lot of low cost bases in them? So there's a lot of questions that go along with some of these risks that we're dealing with. Let's just talk a little bit about the bonds in the portfolio. There's a lot of different types of risks associated with bonds. Number one, you have interest rate risk. Bonds usually are measured by a figure called duration, and duration really kind of measures how much of an interest rate movement affects the price of my bond. And the longer the duration and the change in interest rates, the more you'll be affected from a performance standpoint. We have a 2-year, a 3-year, and a 5-year bond in the portfolio. They are all U.S. government bonds, and usually we like to say that since they're issued by the U.S. government that we're not going to have any default risk. The other risk that we probably don't have to worry about would be downgrade risk. Although we have seen quite a few governments in the past get into some debt situations where they have had their ratings downgraded. So this isn't something that we can completely alleviate, but these are risks that we really have to worry about in your bond portfolio. Finally, let's talk a little bit about the performance of the portfolio. And, we know that over the last 5 years, we've had the S&P grow at about 7%. And if we took the portfolio, the performance of each one of your stocks, we see that there's only a couple of them that did not outperform the 7%. That was stock B at 2.89 and stock C at 5.74. So what we do know is that all the other holdings have done extremely well, and then we've outlined this in the spreadsheet in your plan. We also have taken an approach of looking at what did we expect out of these in regards to returns of these individual positions, and how did they perform. And we see from using the CAP-M pricing model and a 2% risk-free rate in the 7.1% market rate we incurred over the last 5 years, we see that there was actually 3 stocks that underperformed how we expected them to perform, and that was the A, the B, and the C. Finally, let's talk a little bit about the trainer ratio. And the trainer ratio, is really a way to compare different types of investments. It's geared to be really kind of give you a performance per unit of risk. And a lot of times people use the Sharpe ratio, which really measures a standard deviation of the investment. But in this case, we're measuring the beta that we talked about a little bit earlier. And that calculation is the return on the stock minus the risk-free rate over the beta. And what we do is we rank the holdings that we own in a portfolio to see what has the best trainer ratio or the best risk-adjusted return in your portfolio. And after doing this, we see that stock D is giving us the highest rank of a 6.77 trainer ratio, which is nice because we happen to own a lot of that stock at 20%, which, as we discussed, that concentration risk is pretty high. So in essence, I kind of want to summarize a little bit and give you some food of thought that I think we should look into going forward. And first of all, when we start talking about risks in this portfolio, we want to know what really are your goals in the portfolio. And I think in order to really establish strong realization of what you're trying to achieve, we need to create an investment policy statement. And in that statement, we want to create an asset allocation that kind of meets your needs or meets your risk tolerances. And I've outlined what I thought what a moderate risk tolerance asset allocation might look like. And yes, there probably should be some rebalancing or adjustments to the portfolio today based on what your asset allocation should look like. Second, we need to understand what the taxation is in the portfolio. And I know this is your own personal investments, and it probably is non-qualified in nature. So, we need to be aware of the taxation. Therefore, we're going to need all that cost information on the portfolio, and we're going to have to be very sensitive to how we reallocate those equity positions. We also want to be sensitive to what we're doing in the bonds. So, there's at a 28% tax rate, we want to know exactly what is the best option for us, whether we should be in municipals or we should look into corporates. So there's a lot of work to be done there. We also want to continue to think about how do we want to allocate and diversify the portfolio. That's the main risk that I see in this portfolio. We have that large concentration. We see a lot of cash in the portfolio. I don't know if that's something that caused you concern, but that cash is causing a tremendous underweight in the bonds. So we need to address just what is it that's caused you to have such a large cash balance, and try to start thinking about ways to implement some strategic asset allocation decisions, and keep in mind the tax consequences of that. Finally, once we're able to over time create this new strategic asset allocation, there's going to be opportunities to tactically change that, and that's where I can help you a lot. But that takes a lot of monitoring. It takes a lot of rebalancing and being aware, of how that's going to affect the overall after-tax return of your portfolio. I look forward to working with you, and I'm excited about you wanting to learn. Thank you.